Imagine executing a massive financial trade. You follow every rule, wire your funds perfectly on schedule, and yet your money disappears entirely. This loss stems from a mechanical glitch buried deep inside the architecture of global finance. This vulnerability is called settlement risk. It's a quiet flaw in how money moves across borders, and it has previously brought down major banks and frozen entire global markets. Let's look at how this happens in the real world. In June 1974, the global banking system was running its standard cross-border routine. Here in West Germany, local markets were booming. All morning, American and European banks were wiring their Deutschmarks to a major institution called Bankhaus Herstatt. They delivered their end of various currency trades, fully expecting Herstatt to send back the corresponding US dollars later that day. But the dollars never arrived. Exactly at 3:30 p.m. local time, German regulators unexpectedly shut Herstatt Bank down due to heavy trading losses. Because of the time difference, it was only 10:30 a.m. in New York. The U.S. banks had already surrendered their funds, but Herstatt was dead before the returning dollars could be wired out. When the American markets realized the money was gone, chaos erupted. This specific mismatch in time proved that asynchronous delivery creates a vacuum where millions can disappear in an instant. The fallout was so severe it earned a permanent nickname, Herstatt risk. To isolate the exact mechanical flaw that causes this, we can scale things down to a standard currency trade between two individuals. Let's say one trader is in Mumbai and the counterparty is in London. They agree to a simple contract. The Mumbai trader will send 1 million US dollars and the London trader will return 800,000 British pounds on the exact same day. This timeline shows the core problem. The Mumbai trader wires funds at their 9 a.m. open, but the London banking sector is completely offline. We call this the settlement gap, a 5.5-hour void between sending money and being able to respond. This risk is built into the timeline. It exists exclusively within the hours between one party pressing send and the other waking up. If the counterparty defaults during that gap, a trader faces two distinct penalties. The worst-case scenario is called principal risk. This is when the receiving firm goes bankrupt overnight, and the entire amount you sent is lost completely. The lesser penalty is replacement cost risk. Imagine the trade simply fails to process, and your original funds are eventually returned. The problem is, market exchange rates shifted during the delay, meaning you now have to repurchase the currency at a worse price. Either way, the settlement gap guarantees financial damage. You either suffer a loss of your principal, or you pay the penalty of repurchasing at worse market rates. If time zones are an immutable physical reality, how do modern markets avoid Herstatt-style collapses every single day? The global financial sector had to engineer synchronization systems. The first patch is a protocol known as payment versus payment, or PVP. Think of it as an atomic lock. Both sides of a trade are linked, syncing must move simultaneously. If one side fails, neither moves at all. To handle this synchronization at scale, the world's major banks built a centralized global hub called CLS Bank. CLS manages the timing mismatch by holding both deposits in escrow. It only executes the final transfer once both counterparties have verifiably delivered what they owe. By forcing this simultaneous exchange through a central hub, the financial system artificially eliminates the time gap, neutralizing the immediate danger. The final safeguard is a mathematical strategy known as netting, which banks use when they trade with each other hundreds of times a day. This diagram shows how it works. Rather than settling 100 individual trades and creating 100 dangerous time gaps, banks calculate the total difference of all their trades and make a single consolidated end-of-day transfer. These three engineering patches, synchronization, intermediaries, and netting, have heavily insulated the global economy. Yet the underlying flaw remains intact. As long as international trade relies on different geographic locations and currencies, the fundamental problem of asynchronous physical delivery will always exist. Settlement risk is never truly dead. It is a permanent shadow over the markets, proving that the most dangerous variable in global finance is the simple passage of time.